Good afternoon, dear friends and colleagues. Welcome to RAEX Sustainability webinar number 43. And today we will be talking about climate scenarios for the financial industry. This webinar will be in English without translation. After webinar, we will send you all materials, video and presentations. Pavel, next slide, please. And today I have a pleasure to introduce our speaker, Jason Ice, an executive director of Vivid Economics, an economic consultancy with a focus on natural resources and climate change. Our speaker will discuss the climate scenarios for the financial industry and which climate scenarios to use. He will also talk about transition and physical economic shocks, and he also cover an important question for financial institution counterparty level analysis. I'm sure that these topics will be interesting and relevant to all of you, as the problem of climate change is becoming increasingly important and raises many questions related to the assessment, disclosure, and management of climate risks. If you will have any questions during this webinar, feel free to write them in the chat, and we will ask our speaker to answer them in the Q&A section. Now I will leave the floor for our speaker. Jason, the floor is yours.
So we're a specialist consultancy. We've been supporting the financial sector in looking at climate change risk for about a decade. Planetrix is the toolkit we've put together for climate scenario risk analysis, and this is an analysis that can help financial sector institutions essentially understand the nature of climate risks, incorporate that into their risk assessments, into their overall strategy around managing climate change opportunities and risks, and of course engaging externally in reporting what kind of action they're taking and how they're prepared for such risks. This type of analysis leverages a breadth of capabilities, including the core macroeconomic and sector level modeling, as well as physical system modeling related to climate change and its impacts, all the way through to financial modeling, and I'll talk a bit about that now in much more detail. So what I guess overall it is scenario analysis, and why are we using it to look at climate risks? Of course, scenario analysis is particularly helpful when dealing with uncertain future. Climate change broadly is such an uncertain future that the timing and magnitude of climate change impacts is subject to a number of uncertainties, both in terms of transition, what we call transition risk, and physical risk. Transition risk covers the risks associated with moving to a net zero future. So the policies, the technologies, the market developments, and physical risk has to do with the actual climate change impacts which occur as a result of climate change. Because there's so much uncertainty across all aspects of that, it's been deemed broadly most appropriate to think about those risks using scenario analysis. And so what that does, and what we'll talk through now, is it starts to incorporate various possible pathways for how these climate impacts might affect investor decision making, might affect asset values going forward, and both risks and opportunities. And of course, allows for the exploration of a variety of sensitivities around some of the key parameters. I'll talk through now sort of a bit step by step how scenario analysis has been used, using a number of examples, and how that factors into the way the financial industry has used those. Now, a bit of a caveat about scenarios. I think what you'll see, and what we'll discuss perhaps a bit, is how scenario analysis can help provide valuable insights around things like key drivers of risk and the sensitivities around those risks. It can help assess both physical and transition risks side by side, so you can get a whole picture of what the future might look like. It can help quantify what was previously generally only qualitative risk assessments. And it, of course, importantly, can identify the factors that might affect a company or asset performance, and then help drive further areas of understanding. However, at the same time, there are limitations to scenario analysis. They're generally not designed to precisely forecast the future. And we'll talk about how scenario analysis is structured, but they don't evaluate fundamentally the correctness of current market pricing. They give you a sense of the forces that might affect the value of assets, but they don't, of course, try to tell you whether something's overpriced or underpriced at any current given time. There are also a lot of underlying complexities that are often not really tackled very deeply in scenario analysis. And that includes a lot of complexities around how the physical climate system will or won't change. We could have a very long discussion about that, but scenario analysis offers some insights into it, but there are, of course, dimensions of complexity that are difficult even with looking at a large number of scenarios. And so just to say, this means that, of course, we need to remember what scenario analysis does and doesn't do for us. It's a great way to understand the future possible drivers of risk and the exposures and impacts they might have, but it's not a magic bullet to tell us everything about what climate change will mean in the future. Now, in terms of how the analysis is generally structured, this is how we usually present it to people to try to understand the steps of a scenario analysis. So let me walk you through this, and then I'll go through piece by piece how some of that analysis looks and what kind of insights it provides. So we generally think of it around 4 steps. Step 1 is I guess the underlying pathways or the base scenario for what's driving the future. And those are pathways that look both at the transition side. So those are the policies and technologies and market changes that might drive a net zero pathway going forward. And there are pathways related to physical risk. What do we know about how emissions are going to affect temperatures? How do temperatures affect the climate system in terms of amount of warming and precipitation and things like that? The key first step is understanding what pathways one will look at. And of course, this is critically important because this determines the breadth of possible futures that you'll be looking at in any given scenario analysis. And I'll talk about some of the generally accepted kind of pathways that people are using today. So the first step is defining the kind of scenario pathways that you want to look at. And then the second step is looking at the implications of those on the economic system. So how do these changes in policies, technologies, in an actual physical climate phenomenon, how do those go into and affect the economic system as a whole? So what's likely to happen to, in a sense, what you might consider the real economy? And those are a set of direct impacts. So some things are quite straightforward. Is there going to be on physical side, will there be a specific increase in flood risk in a specific area where, say, an asset might exist? In transition, will there be direct carbon taxes imposed on activities or new standards that might be met? And then there are indirect impacts, which is what happens as a result of those direct impacts. So, will changes in carbon price lead to falls or increases in demand for certain goods and services? Will it change prices in a way that affects the value of an asset? And will it potentially, change the composition of GDP or the regional GDP, which has knock-on effects or second-order effects for companies or assets that are serving those markets? So the second step in scenario analysis is understanding how the scenarios translate into changes in economic activity, quantity, prices, costs, etc. And then the third step matches that with what we know about the actual assets and their exposure. Different assets that the financial sector might be financing will be operating in different economic environments. And a key step is linking what's happening to the economy with what might happen to particular assets. And so that's around understanding the exposure of assets. Do we know if that asset is or company is serving a particular market? Do we know if it's in a location that's particularly exposed to physical risk? What is its exposure? The second step in understanding link between those economic shocks and the asset values is how much we think that company or that asset is able to adapt to the risk exposure. So it might be exposed, but it might also have more or less options for adapting to that risk. And finally, how does that sum up into whether that company or asset is more or less competitive? So obviously these economic changes will shift market competitiveness, and some companies, having been exposed, having adapted more or less, will also either win or lose in sort of the market competition. So that's the third step of scenario analysis. And then finally, translating that into financial implications. So once you understand how an asset is exposed, how does that translate into what might happen to the revenues and costs and profits? So in terms of overall equity value, how might those shifts change the likelihood of default risk affecting debt instruments, et cetera. So those are the four steps that generally one might think of as encompassing how climate scenarios are translated into, I guess, metrics that the financial industry can start to use in its analysis. Now, let me walk through a bit the key aspects of that to give you a sense of what it looks like. So let's look at the scenario part first, which is essentially the first two steps: scenarios and kind of economic shocks. So in broad terms, people have generally used a sort of a sample of scenarios to try to cover what you might call the bookends, or the space of likely outcomes in the future. NGFs, which some of you may know, it's the Network for Greening the Financial Sector, which is a network of central banks, which has been guiding much of the financial industry's analysis of climate risks, has set out three representative scenarios: orderly, disorderly, and hothouse. And as you can see from the kind of mapping, that's meant to cover scenarios in which there's either high transition risk, high physical risk, or sort of relatively low physical and transition risk. Now, I've added to this chart another scenario, not an NGFS scenario, but another scenario that has been put forward by UNPRI, and which we've been involved in working on, which is called the Inevitable Policy Response scenario. And that's a scenario that's somewhat in between those other NGFS scenarios. It's got moderately high physical risk, moderately high transition risk, and sits sort of in another, I guess, quartile of possible outcomes. And so anyway, the point is, what you want to do is start to outline what you think is the space, the possible future space, and the kind of the general guidance that the financial sector has been using today is to use 3 or maybe 4 scenarios to get a broad view of that space. It's worth saying that some are using more than that. I mean, so actually underneath the NGFS scenarios are, I think, another half a dozen or so scenarios that you can use. So you don't have to just do 3, you can do 9 or 12, but generally that's the kind of space, 3 or 4, maybe as many as 12 scenarios to try to understand what the future might look like with some specific future narratives in mind. So I'm going to walk through right now the 3 NGFS scenarios: the disorderly, the orderly, and the hothouse, to give you a sense of what it looks like in terms of economic shocks, and then I'll move into looking at some of how that translates into asset values at the asset level. So just to give people a sense, the analysis that I'm presenting now primarily covers a set of climate risks. It's not all the possible climate risks. So it looks at a number of key impact channels. That includes carbon taxes, or even more broadly, carbon costs. So anything that imposes a cost on a company because of its carbon emissions. That may be a price, a market price, and maybe a tax. It may be a stringent standard that forces a company to buy a more expensive technology. We look at energy demand by fuel. So how does that shift in policy or technologies affect fuel demand? It looks at energy prices by fuel, and it also incorporates stranded assets but we'll come to that when we look at the asset level work. That's the transition side. On the physical side, it looks at some of the key risks. It looks at particularly on acute risks. It looks at flooding. It looks at the impact of heat and drought on agricultural and labor productivity, and it looks at adaptation impacts. So how much can you expect assets to be protected by adaptation actions? We don't look in this analysis at some of the full set, including things like wildfires in particular. There are another set of physical risks. We have modeled those in other instances, but not in the results I'm going to show you. And we don't look at much broader risks, like things that you might hear in the news around migration risks or conflict that arises because of climate change. That's actually generally not looked at by anyone, to be honest, today. So the state of the analysis is evolving, is what I would say in terms of how well it covers possible futures. So what kind of stuff do you see from these scenarios? So what kind of economic shocks do you begin to tease out? So from this analysis that we did, looking at the 3 NGFs scenarios, you can see some of the key outcomes across those scenarios and across some key countries that we selected. So in terms of energy consumption, of course, the scenarios differ quite significantly. So if you look at a disorderly or an orderly scenario, you generally see quite significant fall in fossil fuel production, coal, oil, gas, of course, fall quite significantly from today's levels in general, but certainly relative to what you would expect if there was no action. So kind of across the board, as you move in time, across almost every country, you see a fall in demand. That is not always uniform. So under different scenarios, some countries show greater or smaller changes. In general, you often see developing countries continue to see rising demand in oil and gas for a number of years, even in scenarios where there is some climate action, just because of their level of economic growth and their underlying demand. But it is still low compared to what you might expect in a world in which there's very little climate action. Similarly, there are differences between an orderly and a disorderly scenario. So an orderly scenario generally shows a longer term pathway in which there's more use of fossil fuels because essentially we've taken action earlier, and hence the carbon dioxide, the carbon emissions levels across the economy have been dealt with a bit more quickly, and there's more room for generally for oil and particularly for gas in future years. While with disorderly, you see perhaps a little bit higher demand in the short term, but a very sudden decline in that demand in the medium term. So that gives you a sense of the kind of primary energy demand and what happens particularly to fossil fuels versus, say, low carbon energy sources. Nothing too surprising, but it gives you a sense of how scenarios give you different views on how that might happen and how quickly it might happen and how that might differ across different regions. The second transition shock, of course, is around commodity prices. We'll talk a bit about this in more detail, but essentially one of the big impacts will be on commodity prices. Some of them are positive, by the way. Some of them are negative. This gives you a bit of an example on oil price impacts with transition action, that is to say, with climate policy of some kind. Of course, there's generally a contraction in demand for oil. That contraction in demand means that both the quantity and the price of oil will come down, and that leads to different scenarios for possible prices. In most climate scenarios versus the baseline, oil prices would be significantly lower in the long term than what you'd expect in a world in which there's continued demand. And the other kind of shock maybe to think about is the underlying carbon price. So as demand for fossil fuels, of course, falls, as I mentioned, but in parallel you also see fairly significant carbon prices. So if you look at the bottom right hand corner, particularly in climate action scenarios, you see fairly significant prices on carbon that are imposed, and we'll talk about what that means for those emitting sectors a bit later. On physical risk, just to give you a sense of the scenarios, so one set of physical risks revolves around chronic impacts. And so this is really about long-term changes, relatively slowly accumulating changes in average temperatures, changes in precipitation. Those can have various effects. Obviously, they can affect agricultural yields. So in countries that are very dependent on agriculture, or in regions that depend a lot on agriculture, it can very much shift the value of those agricultural assets. That's what's shown on this slide with regards to India. It can also have impacts on labor productivity, especially for outdoor work. And so sectors that rely quite a lot on labor outdoors can see impacts on the productivity of their activities. These damages are then essentially complemented by looking at more looking at more sudden hazards, so acute shocks. In this case, we looked at flooding. Again, flooding will change significantly, both coastal and river flooding. That creates, of course, hazards for assets that are in those flood zones. Those assets then will potentially be exposed and vulnerable to damages, and those damages can then lower again the expected production from those assets, or can increase the costs that have to be invested in creating resilience, whether that's actually building out some sort of adaptation measures, or whether it's through insurance or what have you. It increases the costs or it reduces the productivity. So that's those are the sort of physical shocks and how they play out. To give you a sense of how the physical shocks might vary, here is just a rough synthesis in terms of the percent of GDP that might be the percent impact in GDP terms. So if you look at, we've taken an example of countries: India, Indonesia, Vietnam, Singapore, in an orderly or even a disorderly scenario where carbon emissions decrease and the world stays on a well below 2-degree pathway, the physical impacts are relatively small as a proportion of GDP. 1 or below 1% to say 3% in the worst case of a country like Vietnam, which is very exposed to coastal flooding. While in a hothouse world, those increase from a range of 1% to perhaps 9%. So if you look at the costs and the size of those costs, you can see how they might differ quite significantly in one scenario versus another, but also between one geography and another, depending on how exposed you are. So that gives you a sense of how scenarios translate into economic shocks. Let me see one more slide on adaptation and the importance of adaptation. We'll talk about that again soon. In many cases, depending on what you believe about adaptation, so here I'm showing adaptation with relation to coastal floods, you can reduce the expected loss by half or sometimes 2/3 or more if you expect a strong and very optimal adaptation. Now, in the past, it's fair to say governments have not often operated on very optimally. So an expectation that optimal flood management will be put in place by countries around the world is not always necessarily the right assumption, but it does show that if you do believe there'll be strong adaptation action, some of these risks can be mitigated, and that goes into the kind of way you might now analyze future economic scenarios. So this gives you a bit of a summary of how, say, important adaptation can be. So when you're running a scenario, you want to think about both scenarios that look at adaptation and high adaptation or low adaptation. They can significantly affect the way you would see the economic impacts of scenarios. To give you a bit of an overall summary from the NGFs scenario analysis we did, and this analysis was done together with the National Institute of Economic and Social Research, and it was sponsored by the NatWest Group. From a transition risk perspective, you can see quite a good deal of variation in terms of how big the impacts might be across different scenarios. So this looks at the US, EU, China, and the world as a whole. I guess all of the countries in this instance show a much bigger long-term impact in a disorderly world. So the overall impacts on GDP, by the late 2030s or 2040s can be as much as sort of 6% in a very disorderly transition scenario, versus an orderly scenario where the impacts are a little bit bigger early on, but never really exceed 2 or 3% of GDP. So that gives you kind of a macro sense of how the scenarios translate into economic impacts. And from a physical, if we add in the physical side, you can see how different the impacts are depending on the scenario. So obviously, what we call the hothouse world, which is a scenario with very little climate action, shows some of the biggest effects, with those effects varying quite a lot. So China in this analysis is much more exposed than the US or China. An orderly, where climate action is quick and there's very little kind of overshooting in terms of emissions. Obviously, the physical impacts are very minimal in top of the transition impacts, while disorderly, you get a bit of the worst of both worlds. You get fairly significant transition risks, but you also get some physical risks on top of it. So that gives you a sense of how we went from some scenario narratives into how you move into what the impacts can be. And those impacts can be by specific sector, they can be by specific macroeconomic variables. I guess one last word on this before I move into the asset level analysis and then pass over to questions. One of the things that a lot of financial institutions ask is, how does this translate into typical indicators we might look at, like inflation and interest rates? We've done a lot of analysis around this question. What I would say is it's inevitably complicated. And so just to give you a sense, this slide shows how there are multiple effects moving in different directions, and that they can be sometimes hard to unpick. We talked through the GDP impacts already in the previous slides. Things like impacts on energy prices, impacts in terms of carbon effects, but those have complicated dynamics depending on how the policy is put in place. Carbon taxes can, of course, then be recycled for carbon revenue. For some countries, reductions in fossil fuel prices can be, if you're a supplying country like Russia in this instance, will affect the economy negatively more so than if you're an importing country, where obviously a fall in fossil fuel prices can be beneficial to the economy. So there's many different dynamics that go on under it, and it gets more complicated when you think about inflation and interest rates, at which point you need to think about what the monetary policy response is. What we found is that the overall effects on things like inflation and interest rates depend very importantly on how you think the monetary authorities will respond. Will they lower interest rates in response to lower GDP growth rates? How quickly and how much will they respond to inflationary pressures, potentially from fuel costs? I won't go into it. You could spend hours just talking about the intricacies of it. But overall, just to give you a sense of how scenario analysis is used in the modeling work we've done with places like NISR, you can start to explore those different scenarios. What does it mean for the overall economy? What do you believe in terms of how monetary authorities might react? And then what might it mean for things like inflation and interest rates? Okay, so that's kind of a whirlwind tour through how scenarios are defined in terms of a set of future narratives that give you an overall look at the possible trajectories, how those are translated into specific sectors and macroeconomic impacts. And now I'll talk a bit about how that's translated into financial exposure. So for this section of the analysis, I'm actually going to use the inevitable policy response scenario. The reason I'm switching scenarios on you is because the asset outputs from the IPR exercise are publicly available, so I can share with you the results in a way that I don't have available for some of the other scenarios. So to look at the financial exposure, I'm going to take you through a different scenario than the ones we just looked at, but very similar. The inevitable policy response scenario, which is essentially a mix of both relatively significant climate action, but somewhere between an orderly and a disorderly scenario. And it's based on the idea that as we're seeing climate action unfold in the next few years, policy will begin to ratchet up. So it's a much more fundamental scenario. It looks at the likely pathways for policy and how those might ratchet up in a kind of a medium scenario, something between the extremes that we usually look at. So sorry, just to give you a sense, these are the kind of 4 scenarios. So if you think in terms of global CO2 emissions, the orderly scenario is very sudden shift in economic activity, but more orderly over time. The disorderly went very fast. The scenario I'm taking you through now is somewhere in the middle. Policy starts to ratchet up and begins to move towards a decarbonization trajectory, but is not as extreme as the other scenarios. So that just gives you a sense again of the scenario. Now, what does it mean for the impacts? So as with other scenarios, this scenario shows deep changes in the energy sector. It looks at and outlines how transport shifts, particularly the electrification of transport, and the rapid pace in which you see a kind of the deployment and scale up of EVs. And it looks at a number of other sectors, including what happens to land use, changes in regulations to limit deforestation, the impacts on supply chains, et cetera. So it's a scenario that's quite similar to what we just talked about in the previous section. And it looks across sectors and what the impacts on those sectors might be. Now on equities, what we do then is take those scenarios and we say, how might that affect, or what kind of pressures might that put on the value of those companies? And the way this is done in terms of moving from those economic impacts to exposure is first by looking at current valuations. So we say, look, we know these companies are worth something today. And we take a baseline assumption. And this is a really critical step in scenario analysis. The baseline assumption basically says, let's assume that current valuations are a product of current policy expectations. So you basically say, current valuations reflect what we know today about policy today. It's just a notional assumption, but you do it so that you have some baseline against which you can do the scenario analysis. So the baseline is that current valuations reflect current policies. We then take the scenario, in this case, the IPR scenario, and we say, okay, well, if each of these companies was shocked, the demand for their product fell, the price for their product fell, their costs increased, what would that do in terms of revenues and costs and profits for that company? And how would that change, that delta in possible revenues, costs, and profits compare to their current valuation? So kind of what percentage change might you expect in their current valuation if you thought that there was a sudden shift from expectations of no action or minimal action to significant action? And we then do kind of a calculation of climate value at risk or value impairments. And that's the kind of exercise to get a sense of what the exposure is of different assets. How much are they, more negatively affected? Again, I want to emphasize, it's not meant to tell you whether the price today is the right price. It's just telling you whether there's likely negative impacts in the future. They may or may not be actually priced into the market, of course. And this is the kind of results that we got looking at this for the inevitable policy response scenario. And as you can see, we talked about the energy sector. So let me just explain the graph. Each dot on this chart is a company, essentially. And we looked at global equities. In this case, we looked at the MSCI or something equivalent to the MSCI All World using the iShares ETF. So this is a set of over 1,000 companies across a number of sectors. And these are the kind of impacts that you see when you translate the economic shocks into the company level analysis. And as you'd probably expect from what I said, some sectors like energy broadly, oil and gas are more affected and some are less affected on average. But interestingly, even within sectors, you can get quite a lot of variation. So take utilities, for example. Utilities on average aren't so badly affected. I mean, demand for electricity is only going to increase, even in a fairly significant transition policy scenario. However, some utilities are currently high emitting, based primarily on fossil fuel production assets, and some are lower emitting based more on renewable assets. If you expect significant policy, then you will see a big spread between winners and losers. Some will do better, some will do worse. And the same goes for things like metals and mining. If you're a metals and mining company that's producing a lot of copper or lithium or nickel, you might expect quite an increase in demand as you see demand for batteries and demand for more electricity and electricity networks increasing, you might see more demand. If you're exposed to things like coal, you're gonna have a harder time. So that gives you a sense of when you translate those shocks into specific assets. This gives you a sense of what it looks like, say, for an oil and gas company. Here, as we discussed earlier, the main impact on an oil and gas company is going to actually be the fall in price for oil or gas. To some extent, of course, the quantity, obviously you're going to sell less, but actually, given that oil and gas has such a steep supply curve in general, and price can fall quite quickly with falls in demand, the main impact is profit contraction. If you look at automobiles, it depends quite a lot on where you are in the market. If you expect climate action and you're a traditional ICE or internal combustion engine vehicle manufacturer, you're likely to see quite a lot of demand destruction. If you've created exposure to new vehicle types that are low carbon, you'll see some demand creation. Just take a Ford versus a Tesla is the idea. Now, what does that mean for bonds? Very quickly, bonds, of course, are less exposed than equity. They often have shorter maturity rates, shorter tenors, and they, of course, are lower risk than equity. They're paid back first in the capital stack. So, in general, bond values are affected, much less than equity. Now, that's not always the case that bonds are completely risk-free. So here I've taken just an example of the energy sector, which is one of the more exposed sectors. And as you move into kind of longer tenors and higher and lower credit ratings, the risks of change in bond valuations can become much larger. So broadly less exposed sector, broadly less exposed financial securities, but of course there are patches where you might see exposure increase, and if you're constantly turning over your bond portfolio without thinking about how these risks might manifest, you could find yourself walking into some exposure to those risks. Infrastructure, for example, as an equity class, is broadly more exposed to things like utilities and energy. So as compared to, say, listed equities, a larger percentage of one's portfolio is likely to be exposed to higher exposure sectors. This is using the iShares Global Infrastructure Index to give you an indication here. 60% of the breakdown in an infrastructure index will be more exposed sectors versus, say 10% in a global equity portfolio. So a very different set of exposure, and as a result, a bigger possible impact on infrastructure holdings compared to say equity. So more exposure in infrastructure than in equity. Of course, infrastructure will evolve, and as infrastructure includes more low carbon infrastructure assets, that exposure will change. But today, most infrastructure is still high carbon, and so the exposure in infrastructure is generally higher than equity. And finally, sovereigns. I mentioned earlier, sovereigns are a very complex picture. I won't take you through the entire picture, but one piece of the picture is the negative pressure on GDP. If all you thought about was the effects of say a low carbon transition on debt and GDP, you see results that are relatively predictable. Higher carbon countries in particular, like Canada and Saudi, countries that are relatively highly dependent on fossil fuels and have reasonably high debt levels. A mix of those two things in particular will have higher exposure. Some countries like Australia, which is relatively exposed to fossil fuels, but actually has very, very low debt levels, is still exposed, but less exposed, and so on. So if you look at just the impacts on debt and GDP, generally the numbers can be quite high, but when you start to look at more nuances around what happens to interest rates, these impacts generally come down quite a lot. And in many countries like the US, for example, the impacts can reverse entirely. So the US, from just the perspective of pressure on debt and GDP, might see downward pressure, but once you see what happens to interest rates and how investment shifts across countries, a country like the US and Germany will generally show actually quite little impact. So that is a very complex picture. I won't go into much more detail, but I just wanted to give you a sense of how these economic risks translate over into to ways of thinking about valuation. So here's a bit of an example for the US. The kind of the initial impairment credit risk is negative, but the change in real interest rates actually generally reverses that impact. So it's a complicated picture. I think I'm going to end there. I think we've got 15 minutes left for questions. So I guess, Dennis, if I hand back over to you, I'm happy to take questions.
Jason, thank you very much. You can stop share your screen. Yeah. So thank you very much for this interesting presentation information, which is obviously useful for all of us, for us as a rating agency, for the companies, representatives of financial industry. Also, we have attendees and listeners from asset management companies. And yes, I think it's very interesting, but a little bit complicated information. Yes, but I think if you let us distribute your presentation, we will send and share this presentation with our participants. Yeah, are you agree?
Sure, no problem. That's fine. It's all publicly available information.
So I think we don't have questions from our audience. Maybe we'll wait. I have one specific question. So most of our listeners are from CIS countries and from mostly from Russia. And besides transition risks, it would be interesting to know your opinion on regarding physical risks such as the melting in the Arctic zone. And do you have any experience in developing scenarios for Russia regarding for Russia as a sovereign country? For example, your opinion about Russia government bonds or Russian companies regarding these risks of the melting in the Arctic?
Yeah, okay, it's a very good question. We have looked at Russia. I don't have at my fingertips like a holistic or I guess a detailed view on physical risks in Russia. But I mean, as I think probably people might expect, generally the northern countries, especially countries like Russia that don't have a lot of coastally exposed assets, but are also generally further north, are generally less exposed to physical risk. So as you saw on the slide, some of the countries that we were looking at there as examples, India, Vietnam, Indonesia, are generally more heavily exposed. And so you know, for countries like Russia, Canada, in particular, the exposures are generally lower at a kind of a whole economy level. But in terms of what the physical risks might be in specific areas, I don't have with me kind of the details to answer that question.
Thank you very much. So I have one question from my colleague. I don't understand, but I will read it. So you can read in the chat. So it's a question regarding coverage of climate risks. So could you answer, or if you have additional clarification for this question? Yeah,
sure. I mean, so I think if you're talking about physical risks, I think it's safe to say that the two in particular that were covered in terms of acute hazards, river and coastal flooding, are generally the largest physical risks. When you do the analysis. On top of that, and we've done a good amount of work on a storm, so cyclones, tropical storms, and then wildfires. Those also can be quite significant risks, especially in particular areas, right? So there are specific geographical locations where those become quite big, but they're not as extensive risks as the flooding risks globally, right? So they can be quite impactful in specific areas, but they're not as extensive risk exposure for most countries. Now, on top of that, although it sounds less like less of a big deal, actually some of the chronic risks can be quite significant. So as temperatures increase, it's a bit like boiling a frog. I doubt it will affect those of you in Moscow or Petersburg, but but it is in many countries, the temperature and precipitation risks can actually be quite significant, to the extent that, many outdoor activities become impossible over time. So that gives you, it gives you an overview. As I said at the beginning, there are these knock-on effects which are very poorly understood, around things like migration, possible conflict. There's a history of research looking at the Middle East, for example, and at how the conflicts in Syria may be traceable to drought conditions over multiple years. And so there are all sorts of, more, you might think of them as hard to predict events related to climate change that could become significant, but they're not very well understood.
Thank you very much for the answer. And okay, we have one more question. What could be the source of acute physical risk assessment under the scenarios? Any specific sources for spatial models?
Yeah, so the modeling on acute physical risk is usually around natural catastrophe models of some kind or another. And here there's a whole family of models. So some models, and the models that we usually use if we're going to look at globally physical risks, are kind of moderate resolution models. So for some risks, you might be looking at sort of something like, a kilometer by kilometer spatial resolution. For some, it's better. For some, you might get down to even 30 meters by 30 meters of resolution on some of the flood modeling. But those are still relatively moderate levels of resolution. When it comes to very specific physical assets, so if you have a very valuable building in Manhattan, you don't want to know on a kilometer by kilometer level. You need to know by at a very high resolution, maybe even a meter by meter level assessment, or 10 meters by 10 meters level assessment. And those kind of natural catastrophe models are the ones that are used by insurance companies. We've used them for this analysis in specific cases. So we did work in the UK where we wanted to look at commercial real estate assets, and we looked at very high resolution flood modeling. But that's generally more expensive. So you don't want to do that for every inch of the globe. You want to do that for your Manhattan real estate or whatever it is. So those are some of the sources, and the source, the broad sources that we might use for global analysis are actually, many of them are available open source. Of course, it takes some expertise to be able to use them, but the more high resolution models are generally commercial models, by the likes of RMS, AIR, JBS, a number of commercial companies that do the very high resolution physical risk modeling.
Okay, thank you. Thank you. I hope you answer all the questions, and so we don't have any. Don't have no more questions. So, so if our guests will have questions, you can send us, and we will forward to Jason, and he will also help you with answering, and maybe explain more with the activity of vivid economics, which will be useful for financial institutions from your countries and for the companies. Okay, thank you very much, all of you. Thank you very much, Jason. It was I really appreciate for your participation, and it was a great pleasure to have you as a speaker. And Pavel, can you share our last slide with our next webinars? I want also to mention for guests who were not in the beginning. Yeah, thank you very much. Okay, next Wednesday, as usual, we meet together to our next webinar, which will be dedicated to Sibur case, Sibur experience in financial assessment of climate risk in accordance with TCFD recommendation. This webinar will be in Russian, and also we invite you to webinar this Friday, a webinar hosted by Moscow Exchange, development of new instruments for the responsible financial market in Russia. This webinar also in Russia, and 13th of April, webinar hosted by LuxFlag, ESG data lifecycle from companies to asset managers. We also send you links for registration for these webinars. And I wish you have a nice day, and I wish all of you good working week, and see you our next webinars. Thank you very much.